Hello, everybody. I'm Michael Smith. Welcome to the Lowdown. It's that time of year again. End of the year tax planning for business owners and individuals. Let's get into it. Everybody, I'm Michael Smith, and joining me today is our new Director of Financial Planning, Robert Palmer.
Simply irresistible.
Robert, welcome to the show. I'm excited to have you. I've told many of our clients about you. Maybe we should start off telling us a little bit about where you come from, your background, and basically what are you doing here as our head of financial planning.
Sure, yeah. I'm not a big fan of talking about myself, but I'm going to do my best. So my background was originally in law. So I was working in matrimonial, estate law, tax law, basically ripping my hair out with paperwork. And I was looking for a more entrepreneurial path. So I wound up going toward finance.
Okay.
So my background predominantly is in financial planning, and I tried to leverage that legal background to drive as deep a value as possible for my clients.
Well, and prior to joining Avidian, you were...
Oh, I was a financial consultant at Fidelity.
Okay.
So they have a very interesting model. So basically, as a financial consultant, I run a financial planning team, and we try to help people come on board and get a good plan set up and an investment strategy. And within a short period of time, I wound up in the top percentiles at that company, which was pretty exciting.
Well, good. Well, I'll tell you one thing. I know that you must like Avidian, and here's one reason why, is we brought Robert here in June in the middle of the summer. You're from Greenwich, right? So Greenwich, Connecticut. And you stayed through August. You're still here, and you got a vest on. So you know what? It looks like you survived our summer. So I'm glad you're here and part of the team. But today we're going to talk about, I think, some timely stuff. Again, this is the time of year where CPAs are just scrambling, getting data from everybody. But I think we can provide at least some advice on things people could be thinking about. So where do you want to start from here?
Yeah, I mean, so particularly when we're talking about tax planning, we can either talk about how to save money today or if we're talking about in the future. So where do you want to start?
Well, let's start today, and then we can get into the future later.
Okay. So yeah, I mean, when we talk about today, what we're really talking about is saving money on income tax, right?
Yes.
So the income taxes are coming, the Fed, and depending on where you live, the state are going to come and take their cut. What can you do to reduce it as much as possible? For high net worth individuals, typically they're looking at things like charitable deductions, perhaps some deductions that they can take, from home or from office. They're also looking at tax loss harvesting, right? They're looking at their portfolios. They're seeing where there's gains, where there's losses. How can I offset these, pay a low tax or no tax, and free up the funds for reallocation? That tends to be the most common one right now because the markets are always so volatile. So repositioning, it's a constant chore.
What about this bunching of, or you itemize one year, maybe the other year you bunch up some of the qualified charitable contributions? Maybe explain that. I've heard that term used. Is that something you advise people to do?
Sure, yeah. I mean, when it comes to bunching, just like with any deduction, it kind of depends on where your income is. Okay. So the idea of taking a larger charitable deduction, which essentially is what bunching is, requires a look at your high income earning years and perhaps lower income earning years. In the years in which you are getting a lot more revenue or a lot more personal income, it tends to make sense to bunch because you wind up contributing more toward the cause that you want, and your take home isn't really negatively impacted because you're getting a deduction for those contributions. So usually I will say, let's take a look at where your income is, how it's going to fluctuate over the next few years, and what can we do to reduce your income tax bill moving forward.
All right. Well, so what are the next steps? What are some of the other things that people can be doing? Or should we be looking at maybe business owners?
Yeah, no, that's exactly where you should look. So a lot of high net worth individuals, they tend to own or have ownership in various business entities. And outside certain investments, what they really want to look at is what can they deduct through their business?
Okay.
Right? Are there expenses that they can write off as business expenses? Is there qualified business interest that they can deduct potentially? Is there health care that they can add to their plans and get a credit for? Qualified retirement plans, can they deduct more and avoid tax or defer it later? Those are the types of things you want to be looking at. And then, of course, as a business entity, there could be tangible assets that maybe aren't being depreciated as efficiently as possible. A lot of people will look for opportunities not just to do a straight line depreciation, but perhaps deduct the whole thing in year one, like Section 179. Sure.
Well, what about entity? What about business, formation of those things? Are those things people should be looking at as far as end of the year or maybe going into next year, maybe so much not this year, but later on, maybe getting into the future of things?
Yeah, I think it kind of depends on basically the future of your business. If you're looking for outside investment, maybe you own a C Corp or an LLC and you're looking to recapitalize or restructure as a C Corp, it's important to understand, how retained earnings in these different entities are taxed at the year end or at the end of your fiscal year. C Corps, you have a little more wiggle room. You can kind of choose your fiscal year.
Okay.
But, S Corps and LLCs, if you choose to retain earnings, you're still going to pay personal income tax before the business holds those funds for next year. So that's going to flow right on through. So if you stop and pause and say, hey, I got a ton of retained earnings, I want to keep investing into my corporation, I'm in the highest tax bracket, maybe I should recharacterize as a C Corp and pay only 20% on those retained earnings instead of 37 or 40% depending on your state. That gives you more capital to free up for investment in your own business, and it just gives you more flexibility in the way that you want to move forward with your business.
Now let's think about the future a little bit more. We all know that the sunset provision comes up for the estate tax exemption. I think it's 2026, correct?
That's correct.
Okay, and so that's going, what, $5 million?
Yeah, so right now it's 12.92 million. It's
Okay.
going to be cut into 6.46 million in today's dollars.
Wow. All right. Well, let's talk a little bit about maybe some planning to get ahead of that, or in anticipation of, who knows what's going to happen with that, by the way. That's going to be a political football. But what can people start at least doing now? What are the conversations that they should be having or discussions they should be having?
Yeah, I'm really glad you brought this up because, as I mentioned before, we can look at taxes now or taxes later. And frankly, taxes later, particularly when it comes to the estate tax, it's a hot button issue.
Yes.
Everyone seems to love Congress. So I would say
Do
at the end of the day,
Okay.
I think it's a fairly safe assumption to assume Congress is good at doing very little. And right now, the sunset provision will take hold if they do nothing. So no additional law needs to be passed. No legislation needs to be passed. It's going to happen unless Congress is proactive. So depending on where you want to put your money, that's why it's relevant. Now, when the lifetime exemption comes into play, what that really means is that there's a threshold for your estate.
Okay.
And when you pass away, any asset above that threshold is going to be taxed at 40%.
Ouch.
Yes. So that can have a huge impact on your legacy and on the lifestyle of your heirs if you're not careful, because money gets spent very quickly and rarely survives 3 generations. But if you have the proper planning in place, you can extend that out almost in perpetuity if you're really good at what you do and you got some responsible family members.
So what are some of the things people could be looking at, or at least getting better knowledge of, to help protect them for in case these things happen?
Yeah, as we approach the year end, gifting is always a really important strategy. You're allowed to gift $17,000 per individual right now in today's money. You could double that to $34,000 as a split gift with your spouse, and those are funds that can go into trust for your children. It could be business interests that you're gifting to your children. Okay. So that's always something you want to do by the end of the year because it resets every year. And that's just an easy way to be able to get some of these assets out of your name and into someone else's. But the incorporation of a trust means you're not going to lose control over it, which I think is where most people have a little bit of a hang up when it comes to gifting.
Now, there's some trusts where irrevocable, where you lose control, but then living trusts are things you still maintain control. So it just depends on what your ultimate goals are.
Yeah, that's exactly right.
Well, I'm going to ask you this because many people are asking this question. 2026 comes, like you said, it's automatically going to revert. It's not a matter of them meeting and deciding whether it's going to $5 million. That's going to happen. But here we are, a country. We got $33 trillion in debt. Debt's growing by 18% a year, if not more. I think last week we had one single day that was almost $300 billion in one day. So bottom line is the debt of this country is going to keep rising. We know and we keep hearing taxes where they ultimately want to go. What do you think is going to happen when in 2026 when this comes up? What's that going to look like? What's your opinion, by the way?
I'm going to really like coming to the lowdown if these are the questions you're throwing at me. So, that's a great question. At the end of the day, Congress needs money to help pay for things. And right now, taxes are at a historical low, relatively speaking. So I would say that if I were to make a bet as to where taxes are going, it's more likely that they'll go up rather than down. So, we're already seeing the lifetime exemption being cut in half in 2026, as you said.
Yeah.
So, I think it's safe to say Congress is hurting for coin. It's going to need to find it somewhere, and it's likely going to come after high net worth individuals and business owners because, frankly, Congress really doesn't favor them too much when you hear them talk in the press.
Well, and the good news, and one of the big reasons why you're here at Avidian is because you're going to be helping all of us navigate through this as we start to hear about what propositions, what proposals. We're going to try to help everyone get ahead of this and be prepared, not wait till things are finally done and passed. I think once things are passed, there may be a grandfather provision or things in that prevent people from doing post-planning. So you've got to get this done early.
Well, I think you raise a good point about planning early, because right now, even with the exemption looking to be sunset in 2026, the planning you can do now can lock in the high exemption, right? So if we're starting to look into trust and seeing how much we can gift and lock in, the answer is 12.92 right now. It's likely to be over 13.5 next year. However, in 2026, now you got that cut in half. The IRS isn't going to claw back.
Okay.
Right? So it's a way that we can plan ahead and use that proactive thinking for how best to position these assets moving forward. And so what a commonplace conversation that I have is, particularly with business owners, is an FLP, right? You have an intangible asset, or perhaps a tangible one, that's really hard to divide, right? Mm-hmm. An FLP is a partnership where you can aggregate your assets, set up limited partners who effectively have no real control over the assets within the FLP, and then you, as the general partner of the FLP, have complete control and can gift out that minority interest at a discount. Now, I know that's a lot.
That's okay.
So let me try to break this down a little bit. When you set up an FLP, there's two interests: general partnership interests, which basically control the whole thing, and limited partnership interests, which really don't have much say about anything.
Exactly.
Trusts can own limited partnerships, and you can serve as trustee on those trusts.
Okay.
So, because limited partnerships don't really have a lot of control over the entity, they are given a discount in terms of their approximate value, which means that when you put assets into an FLP and gift out limited partnership interest, that limited partnership interest is likely to receive a discount. So you can gift more efficiently into trust where your trustee still control it and your general partner, and you can charge a fee on the whole thing if you need more income.
Yeah.
So it's just an effective vehicle where particularly ultra high net worth families can aggregate assets and efficiently gift it out to the next generation and escape the estate tax.
And again, to my point, why we have you making complex things, simplifying them, and make it easy to understand. Well, Robert, thanks for coming on, and I think we're going to probably have you on quite a few times between now and 2026 explaining all this stuff. Thank you for coming.
Looking forward to it, Mike. Thank you.
All right, perfect.